Welcome to the deep dive. Today we're uncovering something, well, pretty fascinating in global finance. Imagine this, a multi-trillion-dollar industry, an absolute giant, still running on tech that's, well, seriously outdated.
Yeah, it's quite the paradox.
We're actually talking about private companies managing, get this, what Fairmint's CEO Joris Delano calls billion-dollar cap tables in Excel.
In Excel, it sounds almost unbelievable, doesn't it?
It really does. And it's such a stark contrast to, the robust regulated systems public companies use.
Completely different ballpark.
And the result, well, it creates unnecessary friction, some pretty glaring compliance gaps, and it actually holds back capital formation right here in America.
It's striking, really. You'd think with all the fintech advancements, this sector would have modernized more by now, but it seems stuck.
Stuck is a good word for it. It's this critical disconnect. And that's exactly why our mission for you, the listener, today is to really unpack these challenges in private equity. Then we'll dive into Fairmint's specific proposal to the SEC's crypto task force. It's quite innovative, using Web3 tech, blockchain, basically, to try and fix these things.
And it's not just Fairmint thinking this way.
Exactly. We'll connect it all to this bigger trend, tokenization, moving into traditional finance. We're seeing some major players getting involved now.
It's definitely accelerating.
And just to give you a sense of scale, we're not exaggerating the multi-trillion-dollar part. S&P Global pegged the market at $5.3 trillion in 2023.
Wow.
And it's projected to hit maybe $6 trillion by the end of this year, 2024.
That's a huge amount potentially managed on spreadsheets.
Right. So with that kind of staggering scale in mind, let's peel back the layers. Let's really get into the core problem Fairmint is tackling.
Okay, so if we zero in on that core problem, Fairmint describes it as this outdated and fragmented back-end infrastructure for private securities.
So fragmented, okay.
Yeah, and they really hammer home this critical lack of settlement capabilities in the current software, even the expensive spreadsheet types.
Settlement capabilities.
Yeah.
What does that mean in practical terms?
Well, it means actually finalizing a trade, transferring ownership officially. In the private market, this can drag on for days, sometimes weeks.
Weeks. Seriously.
Yeah, and that introduces significant risk, counterparty risk. Plus, it makes these investments really illiquid for both the buyer and the seller.
Okay, I see. So you're stuck waiting.
Exactly. Compare that to public stocks, right? The transactions happen fast. Settlement is usually within 2 business days. That certainty it doesn't really exist in the same way for private shares.
That's incredible for such a massive market. So if these problems are so clear, the friction, the lack of liquidity, why hasn't this changed? Why so resistant? What's Fairmint really up against here?
Well, historically, I think private markets just operated differently. Very relationship-based, lots of manual processes. Maybe there wasn't that perceived urgent need for a total overhaul.
Inertia, maybe.
Inertia, yeah. And the regulatory side has also been, let's say, slower to embrace new tech in this specific area. Fairmint gets this, though. Their proposal isn't just tech. It includes a regulatory pathway.
Okay. So they're thinking about adoption, too.
Right. And they're not just talking theory. They're already working with clients like Privy, the wallet infrastructure provider, and Bloom Network, that social media platform. They've seen these issues up close.
Okay, so they have real-world grounding. That makes sense.
Definitely. They're actively building solutions based on that experience.
So given those inefficiencies they've seen firsthand, what are they actually proposing? What are the concrete steps? You mentioned a 7-part framework they sent to the SEC.
That's right. It went to Chairman Paul Atkins and Commissioner Hester Pierce. And yeah, these are specific, actionable ideas.
Okay, let's break them down. What's number 1?
First, they're calling for standardizing the infrastructure. Basically, making sure the systems used by different transfer agents can actually talk to each other, interoperability.
Right, breaking down silos.
Exactly, to create a more seamless flow of information and transactions.
Standardizing infrastructure. Sounds logical, but you mentioned fragmentation. What are the big hurdles there, politically, commercially, getting everyone on board?
Oh, huge hurdles. You've got legacy systems people don't want to ditch, established players who might like the current setup, and just the sheer effort of migrating all that data. It's a big lift.
Yep.
But the upside, having that single shared infrastructure, that single source of truth, it would be immense.
Makes sense. What's next in their proposal?
Second is introducing real-time regulatory observability using blockchain.
Okay, real-time observability. That sounds like a potential game changer for compliance. Much more transparent.
Hugely transparent. Near real time, actually. Think about how regulators track things now in private markets.
How do they track things? Must have been difficult.
It was difficult. They relied mostly on periodic reports, filings submitted after the fact, so they were always looking backward.
Reactive, not proactive.
Precisely. With blockchain, every transaction is recorded immutably on a distributed ledger. Regulators could potentially see activity as it happens, or very close to it.
Wow. So they could spot issues much faster.
Exactly. Proactive monitoring, quicker identification of potential problems, it massively enhances compliance capabilities. A huge leap from looking in the rear-view mirror.
Okay, that's a powerful one. And number 3 ties into that transparency, right? Enabling investor self-custody.
Yes, investor self-custody, but crucially with compliance safeguards built in.
Self-custody. That feels like a really big shift for private markets, moving away from intermediaries holding everything.
Yeah.
How would those safeguards work? How do you ensure things like KYK checks without the middleman holding the assets?
Yeah, it's a key innovation. So in this model, investors would control their digital assets directly using cryptography, their own keys.
Okay.
The compliance safeguards would be coded right into the blockchain protocol itself using smart contracts.
Smart contracts, right.
So, for example, the system could automatically enforce rules about who's accredited or manage lockup periods. It could literally prevent a non-accredited investor from buying something they shouldn't, or stop shares being sold too early.
Automated enforcement built into the asset itself.
Pretty much. And KYCML. Those checks would still happen probably when an investor first joins, maybe through specialized third parties. Their verified status could then be linked to their digital identity on-chain, granting them permission to interact with certain tokenized assets.
Fascinating. Okay, what else is in the framework?
Number 4 is a fundamental shift they're proposing, moving towards knowledge-based accreditation standards.
Knowledge-based.
Yeah.
Instead of just income or net worth.
Exactly. Moving away from the traditional thresholds we use now.
That sounds potentially more democratic, but also maybe complex. What are the potential downsides or challenges Fairmint might need to address there? How do you define knowledge?
It's definitely progressive, aimed at wider access, but you hit the nail on the head. The complexity is defining and applying knowledge-based, consistently and fairly. How do you assess it robustly? How do you prevent people gaming the system? You need to ensure investors are sophisticated enough for these often illiquid private investments. It needs careful thought.
Yeah, defining sophistication beyond wealth seems tricky. Okay, what's the last key part?
And finally, they're calling for a regulated DeFi sandbox.
DeFi, decentralized finance. For listeners, that's financial apps on blockchain aiming to cut out middlemen. So a sandbox for that.
Right, a controlled environment. The idea is to let these cutting-edge, sometimes disruptive technologies be tested and developed under regulatory supervision.
So not an illegal gray area.
Exactly. Instead of operating in the Wild West, which can stifle innovation or lead to problems, you create a safe space to experiment with regulatory oversight. It encourages responsible development. So you see, it's a pretty holistic approach, tackling tech, regulation, access.
Yeah, definitely not just one single fix. It's comprehensive.
Yeah.
And you mentioned earlier, this isn't happening in isolation.
Not at all.
Fairmint's proposal really slots into this much bigger movement, right? The SEC's Crypto Task Force is actively looking into this intersection of TradFi and digital assets.
They are. They've held, I think, 2 key regulatory roundtables recently, specifically asking for industry input on tokenization and DeFi.
So the regulators are engaged, they're listening.
It certainly looks that way. They seem to recognize that things are changing and they need to understand it, adapt to it.
And it's not just regulators or startups like Fairmint. Big established financial firms are dipping their toes in, aren't they? Even exploring tokenizing public stocks.
Absolutely. Look at Robinhood, the retail trading platform. They're planning a blockchain network specifically to let Europeans trade U.S.-listed stocks.
Wow, okay. Using blockchain for traditional stocks.
Yeah, it's a significant move. And their CEO, Vladimir Tenev, explicitly said tokenization, including private equity, is going to be their next focus.
Their next focus. So this isn't some niche crypto thing anymore. It's hitting the mainstream financial players.
Definitely feels like it's crossing that chasm.
You hear this phrase now, TradFi building Ethereum L2s to tokenize trillions in RWAs.
Right, RWAs, real-world assets.
Can you unpack that a bit? Why is that phrase significant? What are L2s and why are they important here?
Sure. So TradFi is traditional finance. Ethereum is a major blockchain. L2s, or layer 2s, are solutions built on top of Ethereum to make it faster, cheaper, and more scalable.
addressing Ethereum's limitations for high-volume stuff.
Exactly. For traditional finance to handle the sheer volume and complexity of tokenizing trillions in assets like real estate, bonds, private equity, they need that kind of performance. L2s provide that, bridging the gap between blockchain innovation and what institutions actually require.
So it's like building the necessary highways for TradFi to drive onto the blockchain.
That's a good analogy, yeah. It signals that this isn't just experimental anymore. There's serious infrastructure being built to make tokenizing real-world assets feasible on a massive scale. It's a profound shift.
Okay, so let's bring this all together for you, the listener. What are the key takeaways here?
Well, first, we've seen these, frankly, surprising inefficiencies in the private equity world, a multi-trillion-dollar sector kind of stuck using old tools.
Yeah, the Excel spreadsheets for billion-dollar companies.
Right. Then we dove into Fairmint's proposal, ambitious, specific ideas using blockchain to fix things, like getting real-time oversight for regulators or rethinking who qualifies as an investor.
That knowledge-based accreditation idea?
Mm-hmm. And finally, we saw this isn't just Fairmint. It's part of a much bigger wave tokenization sweeping through finance, with big players like Robinhood jumping in and serious tech like L2s being built out.
And why should you care about all this?
Yeah.
Well, it's not just about fancy new financial tech. It's really about a fundamental push for more efficiency in huge markets. It's about the potential for more people to access investments that were previously closed off.
That democratization aspect.
Yeah. And it's fascinating to watch how regulators are trying to keep up, how they're grappling with these big technological changes. It signals a move towards a potentially more connected, maybe more inclusive financial system.
And that potential for inclusion is really interesting, isn't it? Considering how exclusive parts of this market have traditionally been, it could be a fundamental shift.
Absolutely. Which I suppose leads us to a final thought, something to maybe mull over.
Yeah.
As traditional finance keeps embracing these digital tools, these blockchain innovations, how might the very definition of investor or even private company, how might those definitions continue to evolve in the coming years?
That's a good question.
And what new opportunities might that evolution unlock for, well, for a much wider range of people?
Definitely something to think about, how the lines might blur.
Food for thought. Thanks for diving deep with us today.